Hi, this is Michael Neuenschwander with Outlook Wealth Advisors, a CPA as well as certified financial planner. In today's video, we're going to cover part 2 of our 8 tips for saving taxes in retirement. If you missed the first video, make sure you hit subscribe, go back and watch that for the first 4 tips. So today we're going to kick off with tip number 5, avoiding what we would call the widow or the widower's penalty. What this really comes down to is that if you're married and something were to happen to one of you, taxes don't go up, 5 or 10%. In fact, they typically go up significantly. This can be for many reasons, which we'll touch on here in just a moment. So as we look at this plan to avoid this sort of trap when you go from a married couple to a single taxpayer, you need to plan ahead. This isn't something where you can procrastinate and sort of deal with it after it comes up. So here's what it looks like. When you're a married couple, you have the benefit, obviously, of the joint standard tax return, which today is almost $32,000. You also have the benefit of almost a doubling in the tax brackets, meaning the 12% bracket for a married couple runs to roughly $100,000 of income. For a single person, it's $50,000. 22% bracket, almost 200 for a single person, 100, etc. So as you look at what happens if you were to lose a spouse or a partner on the financial end, obviously there's a whole lot more to deal with on the personal, the emotional side, but on the financial end, generally speaking, the smaller of the Social Security check goes away, the larger Social Security check remains. Depending on your choices on pension, but for many people, if you were fortunate enough to have a pension, you probably chose an option that had some benefit remaining for your spouse, either the full amount or, call it 50, 75%. So the point being, while income may go down some, it's generally not cut in half, but expenses certainly aren't cut in half. In the real world, we see maybe expenses go down 20, 25%. So that oftentimes leaves the surviving spouse in a scenario where they still need not 100%, but they still need the majority of the income that was coming in before. And in fact, expenses are still in that same area. So it moves them potentially from a 12% bracket to a 22%, or a 22 in some cases to 24, or all the way up to 32%. So that's what we would call the widow or the widower's trap. Now, how do you avoid it? You avoid it by planning ahead. When you look at things today, it says if you're both here, you're both healthy, terrific, hopefully we're both here for another 20, 30 plus years. But if you looked and said, well, what if something happened to one of us? And what would our required distributions look like? If you're not required distribution age yet, what happens with required distributions, even if one of you were to pass away, the required distribution is still there, and now it's just on a single person tax bracket. So the key to avoid this trap is to look ahead and say, what does it look like if something happens to one of us? Then what tax bracket are we in? And then you can work backwards and say, if you were potentially in the 22% bracket as a married couple today, but something were to happen to you and you would go to a 24% bracket, or as we mentioned, changes in the tax law, it might not be 24% anymore, it might be 28. Well, now you can begin to plan and say, well, maybe we should begin moving some of that money around and not just focus on the 22% bracket, but potentially let's go ahead and take advantage of the 24. Do we split the difference, average to 25%? So really the key to avoiding this trap is to plan ahead and be proactive and begin moving some of that money around, potentially Roth conversions, so you're reducing that required distribution over time. And as we've said before, we've had a whole separate video about Roth conversions. So again, if you haven't watched that, make sure you either hit subscribe or go back and check that as well. But in doing Roth conversions, Roths have no required distribution. Therefore, that doesn't impact the surviving spouse as well. And we also have a finite amount of time. As we've talked about in the video right before this, one of the other tips is to make sure you're taking advantage of potentially closing tax window. Well, if we've got a few years more where taxes may be lower than normal or historically at low points, this is the time to be doing this kind of planning. So avoiding that widow's tax trap by planning ahead and making sure you're putting your spouse in at least a reasonable tax position if something should happen to you is one of the main things you can be doing, and doing it today. You can't procrastinate on this one. So the next tax tip we'll get into today's video is this idea of controlling what your taxes look like based on where you live. So our primary office is here in the Woodlands, just outside of Houston. And we say, thankfully, Texas doesn't have an income tax. However, Texas has sales tax. Texas also has fairly high property taxes. So to be honest, when I talk to a lot of clients, even if they've moved out of state, some states' taxes are definitely worse. Some states, they may say, yeah, we got a 2 or 3% income tax, but it doesn't tax Social Security. It only taxes capital gains. And sales tax, it doesn't apply, or property taxes are much less. So I'm not implying that, one is always better than the other in terms of whether it's a sales tax or property tax or state income tax. But what we are stressing is you need to have an understanding of how those pieces fit together. And in some cases, if you spend part of the year in one state, part of the year in the other, you may have the ability to say, well, which one are you going to claim as your primary residence? Is there a tax advantage to doing so? Or as you retire or you transition later in retirement and you decide, well, maybe I do want to move out of state. Well, for example, should you move to California, Oregon, some of the other states that have higher taxes? Well, maybe you simply say, well, that's a nice place to live, but I'm going to live on this side of the state tax line instead of the other. So simply one of those considerations that as you're making big life-changing moves, such as moving to a different state, taxes should be a consideration. It's not the bottom line, but if the primary asset you have is your retirement account and Social Security, and ultimately 100% of that retirement account has to go through a tax return, don't make moves without considering the tax ramifications, particularly if it's a state that has a high income tax on all of your retirement income. So, like I said, obviously there's more factors that go into it than just tax savings, but ignoring the tax savings ignoring the tax ramifications is definitely a retirement tax mistake. So the next tax tip is what we'd call maximizing underutilized non-retirement accounts, underutilized asset. Now, in a previous video, we touched on this in more depth in terms of using it specifically for Roth conversions, but another strategy when it comes to those non-retirement accounts. So, as we've mentioned before, many people, when you get to retirement, you may have a traditional IRA 401k, hopefully you have a Roth, some tax-free money, but you also probably have a brokerage, a non-retirement account. And another way to use that account is basically to fill the gaps, if you will. If somebody needed, say, $10,000 a month of income, if that was your retirement goal, part of it comes from Social Security, which we touched on already, can be somewhat tax advantaged because it's not fully taxable. Worst case, only 85% of it counts as income. Some of that can be then IRA money as well. But if purely we looked and said, well, at $120,000 of income, you would be right on the doorstep in today's tax bracket of transitioning using all of the 12% bracket, right on the doorstep of beginning to go into the 22% bracket. And suppose in that year, well, it's time to replace the car. Or, unfortunately, as Houston can relate, there's some storm damage, some other things that have come up around the house, and you need to take a significant, or at least a sizable extra distribution, $10,000, $15,000, $20,000, $30,000. If that were to come all out of the IRA, that extra money would largely be stacked on top of your other income and taxed at the 22% tax bracket. However, if you can use your non-retirement account to fill in those gaps as needed, worst case, you may pay taxes on some capital gains, some dividends, but capital gains at that 22% bracket are taxed at 15%. If that capital gain actually fell into the 12% bracket, it's actually tax-free. So using that after-tax account as an asset to simply fill in the blanks here and there may be the most tax-advantaged way to do it. Second behind that, if you are in a position where you have a Roth IRA, well, you can use a Roth IRA in much the same way, but one word of warning on the Roth IRAs in today's environment, the Roth IRA is worth more to you the moment taxes go up. So if we all believe taxes are going up in a couple of years, at least on the surface, I'd say hold off on using the Roth IRA in the near term. But again, individual facts and circumstances would apply, so that's a scenario. If you have questions or what exactly applies to you, feel free to comment below, feel free to reach out to us. We're happy to have that conversation. So the last tip we want to share with you in today's video has to do with your required distributions and minimizing those required distributions by planning ahead. So the required distributions start at roughly 4%. But by design, they actually get bigger every single year you have a birthday. So if it may start at 4, then it ultimately grows to 5, 6, 7, 8, etc. And that can put you in a position where you've lost tax control. Income just continues to ramp up, so you may be paying more and more in taxes. There's a few ways around it. One, as we've touched on in prior videos, you can go back and watch and learn about Roth conversions and things you need to consider there. One is, can you head off those required distributions before they get there? By planning and converting some of that money out of the IRA account, you reduce that required distribution. Another strategy is using what are called QCDs, qualified charitable distributions. If you're charitably inclined anyway, then it says you can give money directly from your IRA to those charities. It counts as your required distribution, but does not count as income. And when you go through the details on how taxes work, not showing as income is a whole lot better than showing as income and then trying to take it as an itemized deduction. So when we talk about utilizing or minimizing required distributions, it's really about putting yourself in a position where you're not forced to have higher and higher income, therefore higher and higher taxes. And that does well for both if you're in a couple scenario, but the more you can do together while you're both here also benefits your surviving spouse should something happen to one of you. So taking advantage and planning around what your required distribution is going to be, looking at it today, what is it, 5 years, 10 years down the road, and utilizing tools such as Roth conversions, charitable distributions, as well as just simply back to the investment distribution strategy, which we touched on in an earlier video. Putting all those together can ultimately save you a significant amount in tax by reducing those required distributions so that they're no longer potentially forcing you into a higher and higher tax bracket. So in today's video, we've really covered 4 tax tips on how to make sure you're not paying more to the IRS than maybe you potentially should be. This is part 2 of our 2-part series covering 8 tax tips in retirement. In our previous video, we covered the first 4. If you haven't seen or caught that video, be sure to go back and watch that, but also hit subscribe so you can watch our other videos and join us as we discuss other topics such as Social Security planning, Roth conversions in more detail, as well as overall retirement and distribution planning. Hope this has been beneficial to you. Thanks for joining us.